Ladies and gentlemen, after a very strong bull run over the last 1 year, equity markets around the world are staring at the prospects of a very severe liquidity crisis, the likes of which was last seen only in 2019. But the difference between 2019 and now is that back in 2019, inflation was not a problem, and as a result, the Fed could very easily go back to money printing and inject liquidity into the financial system and resolve the liquidity crisis. But that's not the case today. Inflation is a very real problem today. And today, if we get a liquidity crisis, it's not going to be very easy for the Fed to go back to money printing and inject liquidity into the financial system. Because if the Fed does so in response to a liquidity crisis, there's a very real risk that inflation could start to spiral out of control once again. So it's a real catch-22 situation for the Fed, ladies and gentlemen. Hi, my name is Indranil Guha and I'm one of the co-founders of MetaCaps.ai, which is an AI-driven personal finance platform. Ladies and gentlemen, I cannot start this video before first thanking each and every one of you for the kind of love and support that all you guys showed to the last video that I had posted on this channel exactly a week back. As I record this video, that particular video has managed to get about 19,000 views so far. And over the last 1 week, more than 1,000 of you have been kind enough to come and subscribe to my channel. Now, while a lot of you might still be wondering that the kind of numbers that I'm talking about are arguably laughably small compared to the kind of viewership enjoyed by some of the more prominent content creators in the personal finance space of our country, ladies and gentlemen, these numbers still mean a lot to me. Because after all, mine is still a very new and small channel. I started my content creation journey in all seriousness just about 6 months back. And up until last week, I had shared just about 15 videos. And most of those videos would get just about 2,000 to 3,000 views. And I was fine with that because I was always acutely aware of the fact that the kind of topics that I delved into were very, very complex. These were not topics of mass consumption. And hence, I never really expected views on my channel to run into tens of thousands. And that's why it came as a very, very pleasant surprise to see viewership on my last video just explode, at least compared to the viewership that I was enjoying prior to that. Ladies and gentlemen, a big thanks to all of you once again. It just reaffirms my conviction that nobody could be knowing you, and yet if you are prepared to put in the hard work to create content that is differentiated and actionable, then there's going to be an audience for that. Ladies and gentlemen, your love and support will only inspire me to work harder still and continue to create high quality content in future as well. Ladies and gentlemen, before starting this week's video, I want to first address the most common question that I received in the comment section of my last week's video, and that was, where can we find the data for running the strategy that I proposed in that video? Now, for those of you who haven't managed to see my last week's video, I have shared a link of that video in the description section of this video. I strongly encourage you to go and have a look at that video. Now, what is it that I had proposed in that particular video? I had basically presented a framework through which you can potentially navigate the ongoing rally and participate in the ongoing rally almost up until the point that the market is going to make its eventual top for this particular cycle. And this strategy is aimed at also helping you reliably get out sufficiently in advance before a material correction kicks in. So what exactly do you have to do as part of this strategy? What I had proposed is that as part of this strategy, you should remain fully invested in your equity portfolio up until 3 conditions that I had laid down in the video have been fully met. And what were these 3 conditions? The 3 conditions that I had proposed were as follows. First, the balance in the reverse repo facility should have gone down to 0. Fed should have started cutting rates. That's the second condition. And the last but not the least, the yield curve should have uninverted. So these were the 3 conditions that I had laid down in my last week's video. Until all these 3 conditions are fully met, my proposition is that you should continue to remain fully invested in your equity portfolio, and only after all these 3 conditions have been fully met should you plan to start gradually exiting your equity portfolio. Now, a lot of you have asked me, where is it that you can find the data for these three parameters so that you can track this by yourself and take the necessary action with your equity portfolios. Now, ladies and gentlemen, the good news is that the data around all these three parameters is publicly available, and I've shared the links of where you can find the data around these three parameters in the description section of this video, as well as in the description section of my last week's video. So you guys, those of you who are interested, you can go and have a look at the data at the links that I have provided, and you can track this data by yourself. But for those who do not have the time and wherewithal to track this data by yourself, I have good news for you as well, because I'm going to do the tracking for you anyways. And from time to time, I'm going to post update videos to let you guys know how data around these three parameters is shaping up. And I'm most certainly going to provide an update as and when all these three conditions have been fully met, so that you can take the necessary action with your equity portfolios. In return, ladies and gentlemen, the only favor that I ask for is that please do consider subscribing to my channel so that you can get notified as and when I post these update videos. Now let's get on with what I want to discuss in this week's video. Ladies and gentlemen, equity markets around the world have been in the middle of one of the strongest bull runs of recent times. Almost every equity market around the world, including the Nifty here in India, has managed to scale new all-time highs over the last 1 year. The Nifty over the last 1 year has managed to rally by more than 30%. And the most predominant question in the mind of every investor right now is that how long is this rally likely to last? Are we in the middle of some kind of a multi-year bull run, or is this a rally that is likely to fizzle out probably after the general elections? Now, ladies and gentlemen, if we have to understand how long this rally is likely to sustain, what we need to do is to go to the root cause of this rally. What exactly is driving this rally? If you ask me, the most important factor that's driving this rally is market liquidity. Liquidity is basically a measure of the amount of money that is flowing into equity markets. If flows into equity markets are healthy, then even an egregiously overvalued equity market like the one that we are witnessing right now can continue to go up and become even more egregiously overvalued. But if liquidity conditions are tight, if flows into equity markets are not healthy, then even a severely undervalued market will not be able to rebound. So how are liquidity conditions shaping up in 2024? If we have to understand how are liquidity conditions shaping up in 2024, then the most relevant period in history that we need to go back and study is that of 2019. Because 2019 is when the US financial system in particular witnessed one of the worst instances of liquidity conditions tightening, and the resulting liquidity crunch was so severe that not just the equity markets, but also what is called the repo market came precariously close to the point of witnessing the sort of disruptions that were witnessed only during the global financial crisis of 2008. But thankfully, this crisis was averted. And this crisis was averted at the very last moment because the Fed decided to intervene, and intervene very, very decisively by way of injecting a lot of liquidity into the US financial system. And since this crisis was averted, this was not reported and discussed as widely as, let's say, the global financial crisis of 2008. But ladies and gentlemen, why are we discussing 2019 right now? We are discussing 2019 right now because, as I'm going to explain to you in just a while, liquidity conditions in 2024 are shaping up in a fashion that is eerily similar to what happened back in 2019, except for one notable difference. And that difference is with respect to inflation. Back in 2019, inflation was not a problem. And that's why the Fed could very easily go back to money printing and print a lot of money and inject a lot of liquidity into the financial system and avert a crisis. But that's not the case right now in 2024. Right now, we continue to live under the hangover of record high inflation that was witnessed in US and much of the Western world during the course of 2022 and 2023. Mind you, inflation in the US went to a 40-year high of 9.1% in June of 2022. And yes, inflation levels have come down significantly since then, but that has happened only after the Fed has had to resort to a rate hike cycle that has been at the steepest pace in recorded history. And despite these rate hikes, inflation is still not down to Fed's target level of 2%. And ladies and gentlemen, that is why it's going to be that much more difficult for the Fed to go back to money printing and inject liquidity into the financial system if we are hit with a similar liquidity crisis today in 2024. And that's why it's important for us to understand what happened back in 2019 in order for us to be prepared. Because this time round, if as and when we are hit with a similar liquidity crisis, the Fed will not be able to intervene as decisively as it was back in 2019. What exactly happened in 2019? If we have to understand what happened in 2019, we need to first understand how has global liquidity shaped up over the last 10-15 years. And if you have to understand how has global liquidity shaped up over the last 10-15 years, we need to go back to the most important source of global liquidity, which in my opinion is the Federal Reserve. The Federal Reserve, or the Fed in short, is the central bank of US. Like we have the Reserve Bank of India serving as our central bank here in India. In the US, you have the Federal Reserve acting as the central bank of the US. And in my opinion, the Federal Reserve is the most important source of global liquidity, because Federal Reserve is the entity which is responsible for printing the most important currency in the world, the US dollar. Why is the US dollar the most important currency in the world? Because when the Fed prints new dollars, the circulation of these new dollars are not limited only within the US financial system. A lot of these new dollars also end up around the world, including in emerging markets, in the form of FII flows. And as a result, when you have money printing going on in US, it results in liquidity conditions improving not just within the US, but pretty much around the world. Let's understand how the Fed influences global liquidity and equity markets around the world using one chart. The chart that you see on your screen right now represents what is called the Fed's balance sheet size. I know that sounds very technical, but if I have to break it up for you in very, very simple language, what this chart basically represents is the amount of new US dollars that the Fed has printed into existence over the last 15 years. We can also see in this chart that over the last 15 years, there have been two occasions when the Fed has printed new dollars at a very, very fast pace, when this red line has basically gone up at a very, very fast pace. The first time this happened was in the aftermath of the global financial crisis of 2008, and the second time this happened was in the aftermath of the COVID pandemic in 2020. So you can see that on both these occasions, the red line went up at a very, very fast pace. So the red line going up at a very fast pace basically represents that the Fed is printing money during this time at a very, very fast pace. The phenomena of Fed printing money at a very fast pace, when the red line keeps on going up at a very fast pace, this phenomena in technical language is referred to as quantitative easing, QE. And as you can see, the Fed has had to conduct QE twice in the last 15 years, first in the aftermath of 2008 and the second time in the aftermath of the COVID pandemic in 2020. Why did the Fed have to conduct QE after 2008 and once again after 2020? Because these were the 2 years when the US economy witnessed two of the severest recessions in living history. And in response to the recession, the Fed had to step in and print a lot of money in order to provide liquidity support both to the US economy as well as US markets. What is the impact of money printing by the Fed on equity markets around the world? Well, I'm going to be upfront, ladies and gentlemen. When the Fed prints money, that is usually always very, very positive for equity markets, not just within the US, but around the world. Because when the Fed prints money, there's usually an influx of new money into the financial system, and that helps create demand for stocks, and that helps lift up equity markets. If you want to see that, visualize that more clearly, what I've done here is that I have overlaid the chart of the Nifty here. The blue line that I've added here is the chart of the Nifty over the last 15 years. And as you can see, on both the occasions when the Fed conducted QE, on both these occasions, this blue line went up at a very, very fast pace. Which basically means that when the Fed prints money in the US, the red line goes up, and when the red line goes up at a very fast pace, the blue line also goes up in tandem, which basically means that the Nifty also rallies very strongly whenever there is money printing going on in the US. And this happened on both the occasions, after 2008 as well as after the COVID pandemic. So this relationship seems to be very, very tight. Whenever you have money printing going on in US, Nifty tends to rally very, very strongly here in India. And it's not just the Nifty, pretty much every equity market around the world tends to rally very, very strongly when the Fed is printing money. But ladies and gentlemen, we are right now in 2024, and this is not the time when the Fed is printing money. This is not the time when the Fed is conducting QE. In fact, right now the Fed is conducting what is called QT, quantitative tightening. As you can see, this is a time when the red line is in fact coming down. And when the red line comes down, this basically means that the Fed is in fact cutting liquidity. And what is the impact of quantitative tightening on equity markets? Well, to understand that, we have to go back in history and see what exactly happened in equity markets on these two occasions when the Fed conducted QT. Let's go back to the first instance of QT that happened between 2017 and 2019. So what we are going to do is to take a close-up view of this period. This is the same chart, but we are taking a close-up view of this chart between 2017 and 2019. As you can see, the Fed started conducting QT from October of 2017 and QT went on till September of 2019. And during this time, this red line steadily went down. The red line coming down basically means that the Fed is cutting liquidity. And what was the impact of this on equity markets? Well, the Fed cutting liquidity can never be a good thing for equity markets, and we can clearly see in this chart. During this period, the Nifty became very, very volatile. The Nifty tried to make new highs. Nifty tried to break out 3 times during this period. It made new highs 3 times, but it could not sustain these highs on any of the occasions. After making new highs, every time a correction would kick in and the Nifty would give up all its gains during this 2-year period between October 2017 and September 2019. Another thing that is noteworthy in this chart is that something happened in September of 2019 because of which this red line stopped going down, and in fact after September 2019 this red line quite abruptly in fact started to go up. What does that mean? This basically means that because of whatever happened in September 2019, the Fed had to abandon QT and very abruptly go back to money printing. So what is it that happened in September 2019 that forced the Fed to quite literally reverse policy overnight? If you have to understand what happened in September 2019, the root cause of that lay 2 months earlier in July of 2019 when we got a political development called the US debt ceiling deal. Now you might ask, what exactly is this debt ceiling and what was this US debt ceiling deal? Now the way this works is that every government has to impose tax to cover its expenses. But usually taxes are never enough to cover all expenses. And hence governments typically have to borrow to cover for the shortfall. And how do governments borrow? When you and I have to borrow, we usually go to a bank to get a loan. But banks do not typically go to a bank to get a loan. Instead, they sell what are called government bonds. And when you invest in a government bond, you are essentially giving a loan to the government. In case of the US government, there is a limit up to which the US government can borrow. It cannot borrow beyond this limit. And this limit was put in place to ensure that the US government does not become excessively indebted. And this limit up to which the US government can borrow, this limit is called the US debt ceiling. And the way this works is that once the US government's borrowings hit this limit, US government has to stop selling US government bonds and it has to stop further borrowing. And instead, the US government at that stage has to go back to the US Congress. US Congress is basically the parliament of US, and the US government has to seek the permission of the parliament to raise this debt limit, has to increase this limit so that the US government can start borrowing afresh. Now, when this matter reaches the US Congress, the US Parliament, you have two rival parties there, the Republicans and the Democrats. And then they engage in very, very hectic negotiation on this issue. Usually, neither of the parties have any issue with respect to raising this debt limit. Where they tend to differ is where this money, this additional amount of borrowing will be spent on, because this is where their respective political agendas come in picture. Because both the parties basically want this additional amount of borrowing that will be borrowed by the US government as part of the higher limit on debt. Both the parties want that additional debt to be spent on items that are on programs that are aligned with their own respective agendas. And this is where they have to engage in very, very hectic negotiations. So both the parties will fight very hard on agenda items, on spending items that are very dear to them, and there will be some items on which they have to give concessions. But ultimately, a deal is reached between both the parties. And once a deal is reached, this deal is called the US debt ceiling deal. And once a deal is reached, the limit on the amount that the US government can borrow by selling US government bonds, this limit is raised. Now, what is the impact of a US debt ceiling on equity markets? Ladies and gentlemen, the impact of US debt ceiling deal on equity markets is that it usually has a very, very adverse impact on the market's liquidity. Why is it so? It's so because US government bonds enjoy the reputation of being the world's most risk-free asset. And hence, there is virtually unlimited demand for US government bonds. It's very, very unlikely that if the US government comes to the bond market to sell US government bonds, there won't be enough investors who are interested in investing in US government bonds. But in the process, what happens is that the amount that is mopped up by the US government by selling US government bonds, the liquidity of the market goes down to that extent. Understand this with one example. Let's say the total amount of liquidity that is available with investors to invest in all kinds of stocks and bonds is, let's say, $1 trillion. So this is the liquidity available with investors. Now, in this backdrop, the US government comes into the bond market and it wants to sell US government bonds worth $400 billion. The US government will be able to sell bonds worth $400 billion and it will get the $400 billion that it wants. But at the end of this sale of US government bonds, the amount of liquidity that is available with investors would have gone down by $400 billion and the amount of money that would be left with them will only be $600 billion. So this is the liquidity that is available with investors now for investments in other asset classes such as bonds of private companies and in the equity markets. And that's why when US government starts selling US government bonds in very large quantities, that leads to liquidity available in the market for investments in other asset classes to go down quite dramatically. And this is adverse more so if it happens at a time when the Fed is already cutting liquidity. And this is exactly what happened in 2019. As I explained to you, before the debt ceiling deal, we already had the Fed cutting liquidity as part of its quantitative tightening program. And then we got the debt ceiling deal, post which the US government started selling large quantities of US government bonds, which had an even more adverse impact on liquidity. Let's look at the impact on liquidity in terms of hard numbers. Before the debt ceiling deal happened, the Fed was already cutting liquidity at a rate of about $30 billion per month. And then in July of 2019, we got the US debt ceiling deal. And in the very first month after the debt ceiling deal was passed by the US Congress, the US government ended up selling US government bonds worth more than $100 billion. So liquidity was already going down by $30 billion per month. After the debt ceiling deal, liquidity started going down by an additional $100 billion. So the rate of liquidity reduction went up from $30 billion before the debt ceiling deal. Post the debt ceiling deal, the rate of liquidity reduction became 30 plus 100, $130 billion. So the rate of liquidity reduction went up by more than 4 times. And when you have liquidity conditions tightening so significantly within a short period of time, you are bound to get a liquidity crisis. And we did get a liquidity crisis on the night of 17 September 2019, just within 2 months of the debt ceiling deal being reached by the US Congress. On the night of September 17, 2019, we got what is called the repo market blow-up. So this crisis did not manifest itself first in the equity markets. Instead, we got this crisis first in what is called the repo market. Now, you might ask, what exactly is the repo market and what was this repo market blow up all about? So what is the repo market? Well, repo market is a interbank lending market where banks lend to each other. Why do banks have to lend to each other? Well, think about this way. What is the primary function of a commercial bank on any given business day? On any given business day, a commercial bank has 2 primary functions. A commercial bank accepts deposits from depositors and it gives out loans to those who come to the bank to get a loan. Now, at the end of business day, if a bank has given out more loans than the amount of deposits that it has received, then this bank is going to end up with a cash deficit on that day. And vice versa, if a bank has received more deposits than the amount of loans that it has given out, then this then this other bank is going to end up with a cash surplus. At the end of every business day, these cash deficit banks have to go to the repo market and look for banks which have a cash surplus, and they have to borrow from the cash surplus banks on an overnight basis. And this lending happens in what is called the repo market. And the rate at which this lending happens is called the repo rate. And this repo rate is set by the Fed. Back in 2019, the Fed had set the repo rate at about 2%. Mind you, the Fed itself is not lending to the bank. Well, banks are lending to each other. But the rate at which this lending is to happen is set by the Fed. So what was the impact of QT and the debt ceiling deal on the repo market? Well, once the Fed started conducting QT from October of 2017, the liquidity in the banking system started to tighten. And then in July of 2019, once the debt ceiling deal was reached, liquidity conditions started to become tighter still. And within 2 months of the debt ceiling deal being reached, by September of 2019, the overall liquidity conditions in the US banking system became so tight that there was no bank left in the US banking system that had any material amount of surplus cash available with it that it could lend to another bank in the repo market. By September 2019, virtually every bank had a cash deficit. There was no bank which had a cash surplus. Now imagine if you are a US bank which has some amount of cash available with it that you can potentially lend to another bank in the repo market. But at the same time, you also know that there's a humongous amount of cash shortage out there in the repo market. Are you going to lend away that small amount of money that is available with you at a paltry rate of 2% at which the Fed has set the repo rate at? Well, you're not going to do that, because in view of the cash shortage in the repo market, you're going to demand a much higher rate of interest on that amount of cash that is available with you. And that's exactly what happened on the night of 17 September 2019. And this is exactly what happened on the night of 17 September 2019. Against the Fed mandated rate of 2%, the actual on the ground interest rate that banks started demanding from each other on that night shot up to as high as 5.25%. In fact, this is the rate of interest at the end of day. Intraday, this rate of interest shot up to as high as 10%. So basically, there was no cash available in the US banking system. Now, what happens under these kind of conditions? Well, Fed is not the entity which is lending to the banks. Banks are supposed to lend to each other. But Fed is the entity which is setting the repo rate at which this interbank lending is supposed to happen. And by virtue of being the entity which sets the repo rate, the Fed effectively ends up giving a guarantee, an implicit guarantee to the banks that if they are not able to get the cash they need at the 2% rate set by the Fed, then they can come to the Fed and get the money. That's exactly what happened. Everybody ended up at the Fed's doors and started demanding that Fed makes good on the promise of making cash available to banks at the 2% rate that the Fed has set. Now, where is the Fed going to get the money from? The only way the Fed can get the money from is if it restarts the money printing program. And that's exactly what happened on the night of 17 September 2019. The Fed had to abandon QT and it had to literally overnight go back to money printing. And once it did so, as we can see, the red line stopped going down and the red line in fact started very abruptly moving up once again. And as soon as the red line started to go up, liquidity across financial markets started to improve very, very rapidly. And we can see immediately thereafter, even the Nifty responded very positively and we got a breakout in the Nifty. And this rally went on all the way till February of 2020 and was abruptly cut short because of the onset of the COVID pandemic. So this was the story of the first QT. Between 2017 and 2019. What's been happening to equity markets since the second time the Fed started doing QT from June of 2022 onwards? Let's take a closer view of what's been happening to the markets since then. So this is the same chart. I'm just taking a close-up view of the period from early 2022 onwards. As you can see, the Fed started doing QT from June of 2022 onwards, and after that, this red line started to go down. This red line starting to go down basically signifies that the Fed started cutting liquidity after June of 2022. But we can also see that around March of 2023, this red line once again started to go up very briefly. But why did this red line started to go up briefly around March of 2023? The red line started to go up briefly in March of 2023 because we got a bit of a banking crisis in the US regional banking system for a while around March of 2023. We had a bunch of very prominent small regional banks in the US which started to go bankrupt because of the worsening liquidity conditions precipitated by the Fed's QT program. The most prominent amongst these banks was this bank called the SVB, Silicon Valley Bank. And in order to bail out the regional banking system, the Fed had to go back to money printing for a short while. And as a result, this red line once again started to go up very briefly around March of 2023. But this banking crisis was resolved very, very quickly. And once this banking crisis was resolved, Fed once again resumed its QT program. And we can see after that, this red line once again started to come down. What happened after that? In June of 2023, we once again got a debt ceiling deal in the US. So exactly the same set of conditions as 2019. We had the Fed conducting QT, and on top of that, we get the US debt ceiling deal. Let's understand what was the quantum of liquidity reduction caused by QT and the debt ceiling deal. Well, before the debt ceiling deal happened, Fed was already cutting liquidity as part of its quantitative tightening program at a rate of $95 billion per month. And then in June of 2023, we got the US debt ceiling deal, post which the US government started selling US government bonds. And in the very first month after the debt ceiling deal was passed, the US government sold US government bonds worth more than $100 billion. So this is the additional amount of liquidity that was cut from the US financial system after the US debt ceiling deal was passed. So before the debt ceiling deal, we were getting a liquidity reduction at a rate of $95 billion because of QT. After the debt ceiling deal was passed, an additional $100 billion per month worth of liquidity started to get drained, and the cumulative rate of liquidity reduction went up to 95 plus 100, $195 billion. So the rate of liquidity reduction doubled after the debt ceiling deal was passed. What was the impact of this on equity markets? Well, once the Fed started doing QT in June of 2022, we can see that there was some volatility in equity markets. The Nifty became very, very volatile after the start of the QT program in 2022. But curiously, after the debt ceiling deal was passed in June of 2023, after this all volatility in equity markets vanished. And since then, we have had a nearly unidirectional rally in the Nifty since the debt ceiling deal. As you can see, the Nifty has since June of 2023 rallied a spectacular 22%. Now, this is very, very counterintuitive. The Fed has been cutting liquidity as part of its QT program. The US government is making the liquidity conditions still worse by issuing government bonds as post the debt ceiling deal. So the cumulative impact of this is that liquidity is getting drained from the US financial system at a rate of almost $195 billion per month. That's almost $200 billion per month of liquidity being drained out of the US financial system. And yet equity markets are rallying so strongly. There's a complete disconnect between the liquidity posture of the Fed and the direction of equity markets. Why is there this huge disconnect between the two? Well, this disconnect, as I have discussed in previous videos, is because of this entity called the reverse repo facility or the RRP. Now, I have done a dedicated video on the RRP and I'm going to provide a link of that video in the description section. So I encourage you to go and have a look at that video. But I'm going to provide a very brief summary of what I had discussed in that video here very, very quickly. But before we understand what exactly is the reverse repo facility, we need to first go back to this chart of what the Fed was doing in the aftermath of the COVID pandemic. As we had seen, in the aftermath of the COVID pandemic, Fed printed a lot of money. In fact, the Fed printed almost $5 trillion. That's by how much the Fed's balance sheet size, this red line went up by. What happened to all this money? Most of this money first went to the US government, and then the US government used a good part of this money to provide relief, provide support to US citizens who were adversely impacted because of the COVID pandemic, especially those who had lost their jobs because of the COVID pandemic. Such people received direct cash transfers into their accounts from the US government, and these cash transfers happened at a very, very large scale. And as a result of these very large-scale cash transfers to US citizens who had been adversely impacted by the COVID pandemic, the amount of cash, the amount of deposits coming into the banking system went through the roof. There was a lot of cash that came into the banking system. Think about it, when such a large amount of cash comes into the banking system, the amount of deposit in the banking system goes up so dramatically. What would happen to the interest rate that is offered by banks to depositors? Well, this interest rate that is offered by banks to depositors under such conditions would collapse. Because think about it, why do banks have to offer interest to depositors? Banks have to offer an interest to depositors in order to attract deposits. But under conditions where there is already a deluge of deposits coming into banks, banks do not have to offer a very high interest rate in order to attract deposits. In fact, during the COVID pandemic, as a result, the interest rate offered by most banks in the US banking system collapsed to practically zero. And yet, there was no end in sight in inflows of deposits coming into the banking system. And in fact, there was a risk at one point that if deposit continues to grow at the rate at which it was back in 2020 and 2021, interest rate offered by US banks to depositors could well turn negative. Now, if interest rate in the banking system turns negative, that leads to a whole bunch of other problems related to a phenomena called deflation. This is something that has already been experienced in Europe and Japan, and the Fed was absolutely determined that they are not going to allow rates to go negative in the US banking system. And how did the US Federal Reserve prevent rates from going negative in the US banking system? Well, they reactivated this facility or account, whatever you might wish to call it, called the reverse repo facility. So anybody could park their cash in the reverse repo facility, and the Fed would pay you a small interest rate, a slightly higher interest rate on those deposits compared to what the banks were paying you at that point in time. During the COVID pandemic, banks were practically paying zero interest. At that time, if you would have parked your cash in the RRP, the Fed would have paid you an interest rate of 0.15%. It was a small positive interest rate, but a positive interest rate nonetheless. And since the Fed started offering a positive interest rate to depositors on the RRP facility, that meant that banks could not take their rates to negative territory, because if banks took their rates to negative territory, then all these deposits would leave the banking system and depositors would move their cash to the RRP. So that's how the Fed was able to ensure that banks are not able to take their rates to negative territory. But this rate of 0.15%, this small positive interest rate, was back in 2021. Since then, inflation went through the roof in US, and as inflation started to go up, Fed had to start hiking interest rate. And as Fed started to hike interest rates, the interest rate that the Fed started to offer on the RRP facility also started to go up. And as we speak right now, the interest rate that the Fed offers to depositors in the RRP facility stands at a staggering 5.3% per annum, which is a very, very high interest rate by US standards. And as the interest rate offered by the Fed on the RRP facility started to go up, more and more money started to flow into the RRP facility. So this chart shows us the rate at which the balance in the RRP ramped up after 2021. As we can see, as of 2021, there was no balance in the RRP. As of March 2021, the RRP balance was practically zero. But over the next 2 years, the balance in the RRP reached a staggering level of $2.37 trillion. So that's the amount of money that flowed into the RRP because of the higher interest rate that was offered by the Fed on the RRP facility. Now, this was a very, very smart thing done by the Fed, because by offering a slightly higher interest rate compared to banks, Fed was able to create this additional pool of liquidity for the US financial system. And this RRP facility could now provide liquidity support to rest of the US financial system at a time when the Fed itself was doing QT and could not directly provide liquidity support to rest of the US financial system. And that's exactly what happened. From early 2023 onwards, we have had almost $1.9 trillion flow out of the RRP, and these humongous outflows have served to provide liquidity support to practically every asset market, every risk asset, everywhere around the world. $1.9 trillion worth of outflows over the last 1 year translates to roughly about $200 billion worth of outflows per month. As I mentioned to you a little while back, the Fed has been cutting liquidity at a rate of $95 billion per month as part of the QT program. And on top of that, after the debt ceiling was reached, the US government started issuing US government bonds at a rate of another $100 billion per month. So the cumulative liquidity reduction impact of these two factors was about $195 billion per month since the US debt ceiling deal in June of 2023. Against this entire liquidity reduction that was caused by these two factors has been completely offset because of the outflows that has been happening from the RRP facility. So what's been happening since then is that the entire issuance program of the US government has been funded by the RRP. What the US government has very smartly done is that they have started offering an interest rate which is slightly higher on the new bond issuances. The US government has started offering a rate of interest which is slightly higher than what the RRP has been offering, what the Fed has been offering on the RRP facility. Fed has been offering a rate of interest of 5.3% per annum. The US government on its new issuances has started to offer a slightly higher interest rate, 5.35, 5.4% per annum. And as a result, all these deposits which were lying in the RRP started to move from the RRP into US government bonds. So what the RRP did to saving bank balances by offering a slightly higher interest rate, the US government is now doing the same to the RRP. But the US government, despite the debt ceiling deal, is able to get the money that it wants from the RRP, and in the process, the liquidity that is available with investors is not impacted. And as a result, this entire liquidity can then be directed to other asset classes, including the equity markets. And that's how, because of the RRP, liquidity available for investments in equity markets around the world has improved very, very dramatically. And the result of that is that equity markets around the world have rallied very, very strongly over the last 1 year. However, ladies and gentlemen, this party cannot go on for forever, because as you can see, from a peak balance of $2.37 trillion, the RRP balance is now down to just $438 billion. So almost 80% of the balance in the RRP is now gone because of this humongous scale of outflows. And at the rate at which the RRP is getting drained, even this remaining $438 billion could well be gone in next 8 to 9 weeks. And once this remaining balance in the RRP is gone, there would be no liquidity pool left in the US financial system that can offset the impact of the Fed cutting liquidity at a rate of $95 billion and the US government issuing bonds at a rate of another $100 billion. And that's the stage where we could see a resurgence of the kind of liquidity crunch that we saw back in September of 2019, because of which we got the repo market blow up. Well, ladies and gentlemen, as I explained towards the beginning of this video, this time round, if we get a liquidity crisis in 2024, the Fed will not be able to as easily intervene and inject liquidity to rescue the financial system as it was able to back in 2019. Because inflation was not a problem back then. And that's why the Fed was able to reverse policy quite literally overnight. Once we were hit with the liquidity crisis, the Fed was able to reverse policy. It was able to move from QT to QE quite literally overnight and resolve the liquidity crisis that we got back then. But that's not the case right now in 2024. In 2024, inflation is a very real problem. We are still living under the hangover of the super high inflation levels that we witnessed back in 2022 and 2023. And yes, while inflation levels have come down quite significantly since 2022, if we get a liquidity crisis in 2024 and in response to that, the Fed were to respond by restarting money printing in order to inject liquidity into the financial system, there's a very real risk that inflation could once again start to go out of control. And this is something that the Fed is acutely aware of. And that's why in 2024, it's going to be that much more difficult for the Fed to intervene if and when we get a liquidity crisis similar to the one that we got back in 2019. And that's why, ladies and gentlemen, we as investors have to be that much more cautious about a liquidity crisis coming up in 2024, because this time around we cannot depend on the Fed to come to the rescue of financial markets the way it was able to back in 2019. And that's why it's absolutely imperative for investors to have a framework based on which they can continuously monitor the emerging liquidity condition situation, and they can take a defensive posture with respect to their portfolios as and when liquidity conditions start to become very, very tight. And I do believe that liquidity conditions will start to become very, very tight as and when RRP balance goes down to zero or close to zero, and the remaining two conditions that I had laid down as part of my framework in my last video have also been met. And that's why, ladies and gentlemen, it's very, very important for us to navigate the market based on a framework like the one that I had proposed in my last video. Ladies and gentlemen, now I'll start to wrap up this episode. During the course of this episode, it was my endeavor to highlight to you the near-term risk of a liquidity crisis in 2024. And in this episode, we also discussed an investment strategy through which we can potentially protect our investment portfolios from the adverse impact of any such liquidity crisis. Ladies and gentlemen, an investment strategy cannot be about addressing only near-term liquidity risks. In fact, as long-term investors, we need to have a comprehensive investment strategy to time the Nifty as per a rules-based strategy, not just in the near term, but over a 4 to 5 year investment horizon. And this is precisely what I'm going to present to you in the next video. In the next video, I'm going to present to you an investment strategy to invest in equity markets with a horizon of about 5 years. And as part of that strategy, my endeavor would be to address what is arguably the toughest challenge in the world of investing. What is that tough challenge that I seek to address through the investment strategy? Well, that problem is encapsulated in this chart. The chart that you see on your screen right now, this chart encapsulates the historical performance of a 5-year lump sum investment in the Nifty. As you can see, historically, had you invested in the Nifty through a lump sum over a 5-year period, the best case return that you would have been able to get would have been 43.85% per annum. But if you are unlucky to invest in the Nifty between April 2015 and April 2020, you could have also ended up with negative 0.79% per annum, which has historically been the worst case return of a 5-year investment in the Nifty had you invested for a period of 5 years through a lump sum investment. So this is the problem of investing in equity markets, even when your time horizon is as long as 5 years. During your 5-year investment horizon, if markets do well, then you can end up with returns as high as 43%. But during the course of your 5-year investment, if you encounter a large market correction, then you could end up with negative returns. In fact, if you are an SIP investor, the possible outcome can be even worse. This is the historical performance of a 5-year SIP investment in the Nifty. As you can see, the best case outcome of a 5-year SIP investment in the Nifty has historically been as high as 45.43% per annum, but the worst case return of a 5-year SIP investment in the Nifty has historically been negative 5.82% per annum. Is there a way to address this problem? Is there a way to invest in the equity market in such a way such that during the course of our 5-year investment horizon, if the Nifty does well, then obviously nobody has to do anything. Returns are anyway going to be good. But during the course of our 5-year investment horizon, even if we encounter a large market correction, even then we are able to get out with at least bank fixed deposit kind of returns. That's the problem that I try to solve as part of my next episode. So please stay tuned, ladies and gentlemen. This brings me to the end of this video. I hope you liked the insights that I shared during the course of this video. If you did, then please do like and share this video, and please do consider subscribing to my channel. Once again, a very big thanks to all of you for the love and support that you showed to my last video. I can only hope and pray that you will extend the same love and support to this video as well. Thank you very much.